Here are a couple common headlines dominating the financial news cycle right now. A recession in 2023 is now inevitable. Layoffs in tech and finance will spread to other sectors. U.S. Economic Outlook 2023, a soft landing or deep recession? The U.S. economy is currently experiencing levels of inflation that have not been seen in 40 years. Why so many recession concerns? The Federal Reserve has been aggressively raising rates to fight against the high inflation we've seen, raising the Federal Reserve rate 3% alone from June to November of 2022. So we're in a tough spot. Raising interest rates help fight inflation, but it also impacts companies using debt to invest in new growth. They will likely pull back. Cash flow of businesses, more cash flow going toward debt payments than previously, which may also impact the value of those businesses. People purchasing homes, with mortgage rates pricing many people out of being able to afford the monthly payment. These are a few examples. There are many more. This information doesn't make me feel warm and fuzzy about the near future. You probably don't either. So, what should we all do? Is there any respite to be found in all the madness? Here are 5 rules that I believe can help with any internal turmoil you might be feeling right now, and with any internal turmoil you will likely feel in the future. Because if there is one thing I do know with certainty, it's that negative news and recessions and uncertainty will always exist. So, you and I need to figure out how to manage it all with confidence and calm. Here we go. Rule number 1, invest like an optimist, save like a pessimist. Most people behave opposite of this sage advice, investing with pessimism and worry while spending, aka not saving, like nothing is ever going to change and life is good. Here's why you should invest like an optimist. Here's the growth of $1 in the S&P 500 index going back to 1947, with the light gray bars representing recessions in the past. Here's a different visual, and one that is even more powerful. The red is showing any time the market dropped more than 10%. The blue is showing all the growth otherwise. That's a lot of blue growth to be optimistic about despite the red bumps in the road along the way. Saving like a pessimist will cause you to consistently maintain a buffer between what you make and what you spend. This will elicit more resiliency when the economic upheavals come, and they will come. It's substantially easier to go from saving to saving less versus no saving to decreasing your standard of living. Rule number 2, remove excessive debt. A mortgage for a primary residence you can comfortably afford is not excessive to me, especially when you are able to deduct a portion of the interest and the rate is reasonable. A mortgage on a second home you're squeezing into while still carrying a mortgage on your primary residence just might qualify as excessive. Using a home equity loan to finish your basement to rent out that you will prioritize paying back quickly with the rents collected, not excessive in my book. Using a home equity loan to take your family on a cruise, it's excessive. Buying an affordable car with financing to take advantage of the low rate your credit union or the dealership offers you over a short period of time, A-okay. Buying an expensive car with a car loan because that's the only way you can afford it, I'm sorry, I chalk it up as excessive. Excessive debt makes you vulnerable to interest rate hikes. It makes you vulnerable if your pay decreases or you're laid off. It makes you vulnerable to the unknown of the future. Avoiding excessive debt might cause you to have to wait a little bit longer to buy that home or that car or to alter your vacation plans. I don't think that's the worst thing. And I think you'll handle any forthcoming recessions with the heart of a lion, brave and ferocious. How about this? It actually just popped into my mind. Invest like an optimist, save and take on debt like a pessimist. Rule number 3, avoid the temptation to market time. By trying to time the market, I mean, for example, moving a large portion of your investment to cash because of all the negative news. Rebalancing your portfolio to a more conservative allocation because of all the negative news. Transferring your money to a different asset class because of all the negative news. You might very well have a good reason to make one of these adjustments to your investment portfolio. Because of all the negative news shouldn't be one of those reasons. You will always be tempted to time the market because it plays on 2 powerful emotions: fear during bear markets and greed during bull markets. But there's a reason I made this rule with a recession on the horizon. Look at some of the investment hurdles the market has had to overcome the last 10 years. These events tend to cause short-term volatility, sometimes in really extreme cases. But the real mic drop is the graph on your right. The tallest blue bar is showing the return of the S&P 500 index over the time period listed. The next blue bar is only at 5.1%. Why? We excluded the 10 best days the S&P 500 index had over nearly 30 years and roughly 6,000 days. Let me repeat that. 10 days out of 6,000-ish. The subsequent declining blue bars emphasize this point even more, missing just 20 days and 50 days. Yikes, it gets ugly. Guess when many of those best days in the market hit? During volatile times, or more specifically, during the rebounds after a market correction. Mic drop. Rule number 4, don't look at your investment portfolio. And here's why. I think we all take for granted how amazing it is that you or I can go and invest in many of the largest and most successful companies in the world right now. Like literally right now if we wanted to. This allows everyday people to grow their wealth in lockstep with the growth and advancement of these successful companies over time. We can also sell our ownership in these companies anytime we want. We take it for granted because it's so easy. We also often forget and should remind ourselves constantly how this is possible. It's possible because we have a public exchange, and the only way to have a public exchange is to be told what the price of the companies on that public exchange are at any given moment during the trading day. Consider this. If I told you you have to sell your house today and there was a blizzard outside, do you think you could sell it for top dollar? Or would the demand for your home that day decrease, causing you to likely have to decrease what you are selling it for? Every day, the news, earnings reports, interest rate cuts and hikes, investor sentiment, economic data, politics, and much, much more are the blizzards or sunny days causing the sell price of the companies you own to decrease or increase because it's on a public market. Do you concern yourself on the value of your home when it's raining outside? When you have no intention of moving? I sure hope not. You should treat your publicly traded stocks in the same manner. Ignore the storms. Don't look at your investment account frequently. The short-term noise shouldn't cause you to lose sight of the long-term potential that exists. Rule number 5, have a financial plan. Money is a means to an end. Money provides you independence. It provides you the ability to have more control over your life. A goal to travel more. Buy a bigger home where your kids and grandkids can congregate. Retire earlier so you can volunteer. Are all examples of having more control over what you do, when you do it, and who you do it with. A financial plan will turn numbers on an account statement into a visual of how in control you are, or at least provide you a pathway for what it will take to gain such independence and achieve the goals you seek. Why include this rule in my 5 rules with a recession on the horizon? In my observation, those who have a financial plan worry less. And for others who do have a plan but still grow concerned, it's typically a reminder of how they're trending with their goals within their financial plan that brings solace. Not a prediction by me or anyone else of when we think the pain of a market correction will actually end. Last thing, these are 5 rules for life, not just when you or the news thinks a recession is coming. From 1928 through 2021, the stock market dropped 5% or worse in 95% of the years. So almost every year. It dropped 10% or worse in nearly 2/3 of those years. 20% or worse, 30% or worse, 40% or worse. Try to get used to this. I believe these 5 rules will help you control what you can control and manage your emotions and decision making during stock market downturns like these that are out of your control. That's all, folks. Until next time. The Federal Reserve. My nuts got in the way. I was on a roll. I feel like I'm saying so a lot. I didn't catch that in my script. I'm gonna not say it here. Well, maybe I need to. So, you and I, trademark,